Welcome everyone to our third quarter the Path Forward webinar. We're gonna give it a little time for people to join, and then we'll get started. And right before we get started, I want to thank everyone for coming. We know there's a lot of places you could be, so we appreciate you spending some time with us. I want to kick things off by mentioning for compliance, this presentation is for informational purposes only, and it's not intended as specific recommendations other than to talk to your advisor. And of course, we're always available. But compliance loves it when we put up the fine print to actually require it. But let's go ahead and get started. So this is our quarter three Path Forward webinar where we look at where have we been and where are we going. Again, I'm Ryan Moomey, the CEO of Sollinda, and with me is Justin Greenhill, our Chief Investment Officer. And like we said, we appreciate the opportunity to share some of our thoughts. So starting first, the big picture, as we normally do, we start at a 10,000 foot view and then zoom in on some different markets. First slide we'll look at is a look at the path of global rate cuts. What are central banks around the globe doing? And as we see here, by and large, they are cutting. Justin, what do you think about that?
Yeah, thank you everyone for joining. This is pretty straightforward. Blue line up, central banks are hiking rates globally. Blue line down, they are cutting rates. And below the zero line, they are cutting relative to where they started. So you look back to what was the negative market for stocks in 2022. It was very much rates had risen pretty dramatically, and they've since then come down quite a bit globally. And we are increasingly of the opinion that this type of thing means a lot in terms of rates lower, more liquidity, typically better for risk assets like the stock market.
Yeah, that's the takeaway here is a function of liquidity, global liquidity, money floating around the system. And when the line's down, there's more of it. Moving on, tariffs are in the headlines and have been in the headlines for some time. This is a look at the expectations for where various market participants feel like the tariffs are going to end up. And needless to say, what would you say? It's been fluid, Justin? It
Yeah,
keeps changing.
to say the least. I think the takeaway would be there's been no consistent expectation for tariffs. I mean, you can see that back into the February to April period, there was perhaps a expectation for what would be the largest percentage, and since that has come down. But at the end of the day, I think this just shows that not only does no one know where this ends up, but that expectation has changed dramatically over the period of the last quarter or two.
And market participants might be at the point where they're looking past these tariff headlines, certainly more so than they were in April. Moving on to the next slide, we're looking at U.S. GDP, the global impact of the United States economy, and this is the share of global GDP since 1960. And it's trended down and then it's coming back up. What do you have to say about that, Justin?
Yeah, I think, big picture, this just basically shows that over the last several decades, the economies of other countries outside of the US have grown significantly relative to the US, being that they started at such a smaller base. And you'll see, some ebb and flow in the chart, but the big picture highlighted is when China joined the World Trade Organization. That marked a period of time where, relative to the rest of the world, the U.S. economy got a bit smaller. And then in more recent years, you've had a lot of money come into the U.S., dollar strength, and a big story around technology. First the big platform companies, and more recently AI. So a lot of movement, but generally speaking, the trend has been other countries have seen their GDP increase relative to the U.S. from a low base.
And moving on to the collection of duties on imports, back to the tariff conversation. So far, this period this year is 3.5 times the same period last year. So the tariffs are creating some cost to manufacturers and consumers.
Right. And if you tie this into the previous chart, you could simply say that a lot of the growth from other economies has been due to the fact that they've built up huge exports into the US, which, especially in the case of China. And this just simply shows that when you increase tariffs on those, in terms of the US, what are imports, that ends up being a lot of revenue into the country.
Well, and we know this money's is going to have to come from somewhere, right? And that extra tariff cost, here's an expectation of where that burden's going to go. Where will it end up? Here's some estimations from some surveys, but the bottom line is it comes down to, will it come from corporate earnings, corporate margins, or will it be passed on fully to the consumer?
Yeah, this is a really interesting chart. So dark blue line is just simply the percentage of the tariff cost that is supposed to be, taken by U.S. consumers, and then the light blue line is U.S. businesses. And you can see basically in both charts, whether it be the Goldman Sachs assumption or whether it be the Federal Reserve survey assumption, foreign exporters are actually going to bear the cost, at least according to this analysis, far less than U.S. consumers.
Yeah, and this is back to the tariffs often are associated with inflation, right? If it's costing more and there's the same amount of goods, economics 101, that's going to drive the prices up. But again, to be determined, where does it end up? This has taken a big look at consumer spending. It's a big part of the United States economy and globally. And credit card spending is down year over year. And this is the first time since the pandemic that has happened.
And yeah, what's interesting is if you look at this year over year throughout, this analysis that went through the bulk of June, you're really seeing airlines, you're seeing entertainment, you're seeing department store, and you're seeing home improvement. Those are the things that year over year are down the most. Versus, as you can see here, total online retail is actually up pretty notably. So it's hard to really take a big takeaway from this. I think the only thing that we could see is you could say there's pockets of slowdown in domestic consumption. I think is a safe takeaway from this graphic.
And the old saying, it's shifting to online purchasing, can't fully explain that away. This is one of those data points you observe, but there's not really any action to do. It usually explains things in hindsight. Here's a look at the labor market. This is the most recent survey that in June that everybody got really excited about. That the takeaway at the headline level was the labor market has remained strong and resilient. But we dug a little deeper.
Yeah, the headline number and the headlines have maintained strength in the U.S. labor market, which has been kind of against many's expectations. But in the most recent, as you can see here, it was government and healthcare plus social assistance that really led the positive in terms of job creation. And as you can see here at the bottom, it was manufacturing and professional business services, which actually showed some weakness in terms of those areas. So, what's interesting about this is one of the big criticisms of the prior administration was that a disproportionate amount of job creation was happening in government. And, thus far, that trend has carried over into the new administration as well.
And the counter to this is all the capex, all the money being spent on artificial intelligence is the labor. We don't need as many jobs, or we won't need as many jobs. So again, to be determined. There's a joke that fundamentals don't matter anymore, and maybe that's partially true. Maybe it's not, but we will know in time. Let's move on to digging in a little deeper into the U.S. stock market. So this first chart just basically says what a wild ride we've been on. I was on the radio recently, and they asked for my takeaway of the first 6 months, and I said that nobody had it on their bingo card that the first 6 months, considering everything we've been through, you'd end up with the S&P near all-time highs, gold near all-time highs, U.S. Treasury rates actually down from the beginning of the year, and inflation down from the beginning of the year. But it's been a wild ride.
Yeah, to say the least. And I think the big takeaway from this chart, you can just simply see that a lot of the price action in the market has been on headlines, be it initially negative headlines, and then more recently, what has been taken as more positive headlines. So unless someone had a view on what headlines were going to be before they came out, this has really just been an environment that's been very difficult to position for, I guess you could say.
Yeah, and it's been a great opportunity for our advisor partners to talk to their clients about, where's your financial plan at through all of these different snapshots in time, and what's most important to you. Is it risk mitigation, meaning staying out of the way, avoiding crash risk, or is it maximum upside? Because you can't have both. You can't have focus on risk mitigation, and also participate fully 100%, and maybe exceed the upside. So it's been an unbelievable opportunity for that conversation around what's your risk? Is it risk of not making enough, or is it your risk of losing too much? And that's a question every investor needs to work with their advisor on, and hopefully tie it back to their financial plan. This next chart looks at the forward price to earnings ratio over time. This goes back to right before 2008, of the S&P 500. And although we had quite a bit of contraction in April, it's bounced right back, Justin.
Yeah, so you could kind of look at this in two different ways. You could say that not only are the forward earnings multiples now back to all-time highs, but you could also say that clearly there's been an upward trend in these multiples over time. So there's a few reasons to explain that, but I think the most simple could be that the big companies of which represent the S&P 500 have just simply become more efficient, and companies that have higher profit margins are more efficient and are more immune to economic cyclicality. They carry a higher multiple. And another explanation could just simply be there's more money in the world going into stocks, and that has also contributed.
Yeah, but the bottom line is people are willing to pay more per share for $1 of earnings than they were in the past, right? That's bottom line what it's saying, and that doesn't necessarily by itself mean that we're going to see a massive contraction towards the historical mean. It, as Justin said, could just mean companies are going to trade at a higher multiple. This is a look at the dots represent when the S&P 500 has hit a new all-time high, and what you see is oftentimes those are chunky.
Right. I think this is a very important chart, and this just basically kind of adds to the adage of new all-time highs in markets historically tend to be correlated with more all-time highs. You can see that when it's red, it often comes in big patches, but every once in a while, be it you see it back here where it's being highlighted currently, and then you see another example of that here. Occasionally, it can in fact be a false, but time will tell.
Time will tell. How do I get rid of the? There we go. It's good. Moving on, this is a look at the volatility index, the fear gauge relative to when the S&P 500 hit all-time highs. There's a lot of dots there, but we put this on here to simply show that volatility is in a we've had a higher volatility regime recently, and that hasn't always been the case.
Yeah, I think we could just kind of unpack it and say the period of time post global financial crisis, really up until before the pandemic, saw all-time highs in the S&P 500 associated with lower volatility versus post-pandemic and, in today, which is highlighted there on the far right, the volatility as measured by the VIX is actually not low relative to the fact that markets are at all-time highs. So does this mean that, participants in the market are still a bit cautious and they could increasingly become less cautious and volatility comes down? That is, potentially there to be a catalyst.
Yeah, we talked last at our last quarterly about are we in a period of complacency by market participants, and this would suggest that there's still plenty of hedging going on. And while volatility could increase, putting pressure on the US stock market, just as much, people could begin suppressing volatility and it drops to the levels Justin mentioned pre-pandemic. That provides a natural lift to equity markets in general. So it's something we monitor, but there's not really a major takeaway from it today in isolation. Moving on to equities outside of the United States, is if you've turned on your TV or your Twitter or Instagram feed, you know that the U.S. dollar is down year to date. It's having its worst start to a year since at least 2005, and the obviously non-U.S. equities have benefited from this.
I would say the most important thing is that Ryan just admitted he's on US dollar Instagram.
No, I am not.
In all seriousness, this has come down, quite a bit, pretty much in a straight line lower year to date. But as you can see, it went up pretty significantly at the end of last year. So there's been some dollar weakness. There's been big calls here recently across, let's call it, the analysis community for further weakness, but we're pretty neutral in terms of what this is, and I think we're going to have to get some more clarity on some of the drivers, be it U.S. growth, U.S. interest rates, and perhaps maybe more importantly, what's going on with growth outside the U.S. to get an idea of where this might go from here.
As we talked about in the last slide with the U.S. dollar, non-U.S. equities have outperformed year to date, but zooming back again, a chart going back to right before the financial crisis, this has been a ongoing trend of U.S. equities outperforming the rest of the world.
Yeah, so line lower here is simply non-U.S. equities. If the line goes lower, non-U.S. equities are underperforming U.S. equities, or to say it in reverse, the U.S. stocks, the S&P 500 are outperforming. So you've heard a lot about, international stocks have outperformed year to date, which is true, but in the big picture, that's a very tiny blip on the far right of the screen, which for now at least appears to be rolling back over once again. So just based on simple, chart analysis, there's really no evidence to suggest, at least yet, that non-U.S. stocks are set to sustainably outperform.
Yeah, because there's been several of these period pockets of outperformance throughout time, and the question is, does this continue or does it revert back to what we just talked about has been a 20-year trend here, and to be determined. But what we do know is there will be pockets of opportunity out there. This looks specifically at South Korea, which in one of our strategies we were able to take advantage of this this relative strength earlier this year. But this just shows them relative to their Asian peers.
Yeah, black line is the Korea's Kospi index, and then you've got Taiwan, Japan, and China here as well. And as you can see, really going back post-pandemic, Korean stocks have traded at a discount, and one of the reasons for that has just been very national-specific dynamics, where the government and rules and regulations tend to sort of oppress innovation and shareholder value. There's recently been an election, so there's potentially a catalyst that could change, and potentially you're going to see on the margin money rotate out of these other Asian markets and perhaps into Korea. So we think that's something that might continue to play out regardless of what happens at the big picture macro level globally.
And before we get into this slide, I want to remind everyone that there's the Q&A button at the bottom of your screen. If you have a question throughout, fire it away, and at the end we will address them. This slide looks at Brazilian equities relative to in United States dollar terms, and basically it's went nowhere for 20 years. It's went sideways, been pretty range bound.
Yeah, this is obviously currency adjusted. So this shows, if you are denominated in dollars and you were choosing to invest in the market cap weighted Brazilian stock market, you've pretty much gone nowhere. Currency adjusted. This particular market does pay a very large dividend every year, so you have gotten that, and that's not reflected in this chart. But I think the big takeaway is there's an election taking place next year, and as you can see, this particular market does have pretty significant periods of time where it either does well or does poorly. So it's not a buy and hold market, or at least it hasn't been historically if you're denominated in U.S. dollars, but it does have periodic trading opportunities.
And Brazil is really important to all of Latin America. So Latin America oftentimes, especially in South America, they're going to follow what happens in Brazil. And right now, Brazil has what's viewed as not necessarily market friendly administration. And so, as Justin mentioned, big election coming up for them next year. Moving on to the interest rates and fixed income marketplace. Again, nobody wants to talk about this at the cocktail party, but as I say, it's substantially larger than the stock market, and oftentimes what happens in the rate market drives what happens in the stock market. And this is a chart we talked about in a chart overload episode, but it's just really important to what's going on right now that we thought we'd spend a little more time on it. And this just looks at the interest rates in the U.S. relative to the rest of the major developed countries. And as you can see, we are on the high end.
Outside of Hong Kong, it's or I would say other than Hong Kong, it's by far the highest. And the Federal Reserve, Jerome Powell in particular, has come out of late and said very straightforward, normally he would have probably cut rates by now, but there is concern that there's going to be inflation from tariffs. So that's created a little bit of a hesitancy. But, as you can see, if US rates were simply to catch down to the rest of the developed world, there would need to be some pretty significant rate cutting in the quarters ahead.
And then this is a look at real rates relative to the rest of the world as well. And Justin, why don't you give a simplified what real rates are?
So this particular graphic is taking what is the policy rate, so the rate that the central bank is setting, and then it is subtracting what is the CPI, which is the headline inflation number. But to add one more layer, it's core CPI, so it's netting out some of the more so-called transitory items, whether that be energy, et cetera. And as you can see here, this is perhaps more dramatic than the prior chart. It basically shows that there was a period of time, really post-pandemic in particular, where real interest rates in the US, which is the dark black line, were deeply negative. And now they are firmly positive, and positive relative to much of the rest of the world.
And this, again, just oftentimes restricts some movement of money, if you will, some liquidity. And we will talk a little more about real rates relative to gold later in the presentation. This is a look at the ratio of performance relative to the 5-year U.S. Treasury, shorter term maturity versus the long end, the 30-year. And as you've seen throughout throughout this year, they've continued to outperform the shorter maturities.
Yeah, in terms of rates have gone up more on the long end relative to the short end is basically what this is showing. And the consensus narrative around that is, rising fiscal deficits and, so on and so forth. But really, I think one could think of it is that if you're buying a 30-year bond, you do have a fixed rate of return, a coupon, so to speak, but you obviously have to hold it for 30 years to get that. So oftentimes a way to look at it is long duration bonds really trade more like equities in the sense that it's very much based on price momentum, sentiment, narrative, positioning, etc. And for some time now, the long end of the U.S. Treasury yield curve has been increasingly unpopular for, pick your reason.
Yeah, the last couple of years, it's had some of its worst performance going back decades. And so people could be a little gun shy to go back into the long end of the curve, given the recency bias of what's happened. Again, if you have any questions, this is our last section. Hit the Q&A button and type her in there. We're talking about commodities now, obviously the black gold, oil, and what you see here is the conflict premium between Israel and Iran is already gone.
Yeah, pretty much all year, oil's gone notably lower. And there was some stabilization around April, May, following what was the Liberation Day sell off. And then obviously you had a very short lived spike on the Iran conflict and it sold right back off. So you could really look at this chart and say the oil market is saying that demand is potentially suspect going forward because it's undetermined what tariffs are going to actually do to demand. But I would say most importantly, there's just an excess of supply of oil. So you've got OPEC plus, led by Saudi Arabia, increasing output. You have U.S. shale increasing output, and then you have various other countries back to Brazil being an example that is increasingly increasing its export output.
Yeah, and one of my points is the sensationalization of news flow, if you will. Lots of people were back in that June timeframe when we had a spike calling for $100 a barrel oil, and again sensationalizing things when none of that came to fruition. And as Justin pointed out, oil is settled back down into the trading range it's been in for most of the year. Here's a look at copper. There was some big news on copper with a tariff threat here recently, and as such, we've seen it close at its highest level ever.
Copper's been an interesting market for a few years. There's been a bullish narrative, which generally speaking is around the fact that there's going to be more demand for copper for electric vehicles and the transition to the new energy economy globally, while at the same time the analysis put out by whether it be investment banks or copper producers, et cetera, has been that the ability to get more copper out of mines has become as difficult as it's ever been. So you combine that with some tariff threats on copper imports to the U.S., you can understand why this market keeps moving higher. But one ripple effect to consider is if copper is more expensive, that makes U.S. manufacturing that requires copper even less competitive.
So it's something we're paying attention to. And again, it was just a threat, but if it falls off and they back away from it, you'll see this chart, come down. It's back to we talked about on our last quarterly view that headline bombs is headline risk is a real risk this year that we really haven't had to deal with for some time. So was this a headline bomb, a headline risk, or is it real? To be determined. And final slide, as I talked about, we would come back to real rates. This is a historical relationship of gold and in real rates. And in the past, gold has followed them.
Yeah, and think of it like this. We talked about this. I think we used this chart or some version of it in one of our recent chart overload presentations. But historically, when real interest rates go up, that just simply means that the yield you can get from government fixed income above inflation is higher. And because that income can come in, that usually takes money away from gold. We've, despite what has been a significant rise in real interest rates, the blue line here to the right of the chart, we've actually seen gold strength, which would just imply that that correlation has not only broken down, but there's been additional drivers of gold to go higher. And from here, we think it's pretty interesting. I mean, gold has a lot to prove if it wants to keep going up because real interest rates are staying high. And we think that, there's potentially a disconnect there that might mean revert.
Yeah, and we know, why gold has at least broken the historical relationship since 2024 was central bank movement, central bank demand for gold, but much of that's been done. And as Justin said, where does it go from here? To be determined, but real rates as the Fed driving that, Jerome Powell has said he's going to keep rates up until we get through the tariff situation. So where does gold go from here to be determined? Um, Now's the time we'll move on to some questions. Um, we we've got a few. Number one, do we see rates dropping for the housing market in early 2026? Great question. The mortgage rates are traditionally driven by the 10-year US Treasury rate. That's often what they're benchmarked to. So the question really is, where do we see the 10-year US Treasury going from here? And the answer is it depends, right? It depends on where do we end up with the tariffs, one, and two, where do we end up with that pass-through cost? How inflationary is it really? Because the 10-year and the 30-year US Treasuries are driven by market participants' anticipation of future economic growth and future inflation. So if it's viewed that we're going to see an uptick in inflation, then the 10-year yield's going to stay up, and as such, mortgage rates will stay up as well. But if we see things softening, then we'll see that come down. Justin, what's your take on that?
Basically the same. I just think we're going to have to get more clarity on, what the Federal Reserve is going to do, and whether that is the economic data that comes in for the third and fourth quarter of this year, or that could actually be, the chairman of the Federal Reserve being replaced and someone new coming in who is going to cut rates more aggressively no matter what. That would also be a big factor. So we sort of view interest rates as something you don't necessarily have to be too early on, because back to our very first chart in this presentation, they tend to move in pretty long-term trends, either higher or lower. So we're currently already coming off highs, so they've already come down some, and we'll see if that pauses for a while or if it accelerates lower. Too early to say.
Yeah. Another question on copper. Copper's historically been viewed as a leading indicator for economic activity. Do we think green initiatives, AI tariffs are causing trends that will cause the relationship to break down? Copper at an all-time high would normally signal expansion in the economy. Correct? What are your thoughts there, Justin?
I would say, relative to history, that correlation has broken down. And I wouldn't say that that's just an opinion. I would say that you could look at your classic copper to gold ratio versus US interest rates. And historically, you see a situation where when interest rates are high, copper has done well relative to gold. And that correlation has also broken down. So That's not to say, though, that there is no demand in the economy for copper. I just think that those drivers are changing quite a bit, and I think perhaps more importantly, one needs to remember that there's a lot of money out there in the world that wants to chase trends in all markets. And when you get one of these markets, be it copper, be it coffee, be it cocoa, you name it, moving in one direction, you tend to see money sort of pile in, and that'll push markets in one way or the other until they can often quickly reverse on new realizations of fundamentals.
Yeah, it's the combination of the real economy, people buying copper to build buildings or chips or whatever, and then speculation, people investing in copper just to trade the price, and that oftentimes will create some disconnects for periods of time. And what do you need to determine if it's a new reality or if it mean revert to historical trends? You need time. Um, so not trying to be vague, but to be determined. Another question relating to quarterly analysis in the beginning of the year relative to our strategies allocations. Um, were our assumptions validated? In second question, where do we see things going throughout the end of the year? So I would say on our strategy front, we have two buckets of strategies, if you will. One is what we call our core strategies, where we stay fully invested um, almost all the time, and we're rotating allocations based on strength or weakness in various areas of the market. Then we have more our active strategies where we're trading more often on, we use the same data sets. It's just a matter of how quickly we're placing, we're making adjustments. And the more active strategies oftentimes are more focused for or built for clients focused on risk mitigation. So forward assumptions in the active strategies often aren't really valid because we're ultimately trading and adjusting based on what happens real time. That's often why we don't give forecasts, because all of our proprietary signals can change in a moment, and any forecasts we give are subject to change without notice. So I would say that for our core strategies, by and large, our thesis was we wanted to overweight internationals coming into this year. We did so, and our clients have been rewarded as such. Those same clients have fully participated in volatility, right? um, During those time frames. You go back in time to April and you think the market sank, I believe it was almost 20% in very short order. Um, how did you respond then, and were you in the correct strategy, or do you need to focus more on a little less risk? Um, and by and large, since then, as we've bounced back, is risk mitigation as big of a deal for you as you once thought it was? And that's an evolution, and that's why we encourage our advisors to constantly have conversations with their clients, not around just the financial plan, but how do they feel about it? Because we don't want the emotions to drive, but we want to validate those emotions and make sure they're coming from a position of logic. Um, so we're very pleased with both buckets of strategies. Sharp ratio is how strategies are judged, right, in the institutional world, and that's risk adjusted return. So that's we're very proud of that. Core strategies we're also pleased with because of our international overweight. And as Justin talked about, we're now considering, do we want to, ring the register on some of that and get back away from being overweight. So to be determined. And to answer your final question is, what do we see going into the fourth quarter? Any significant changes? I would say again, to our core strategies, the backing off some of our international exposure is probably in the cards at some point. And our active strategies, we have to respect the data, and all of the data. We don't have anything red, as I've said. We've got some blinking yellow lights, but for the most part, we have to respect the signals that we have, and that's that things are cooking, right? And where things end up from my perspective, and then I'll let Justin opine, is I think it comes down to the labor market being one, and the AI capex. Does the labor market stay stable and continue to provide a foundation to the economy? And do corporations continue with this massive capital expenditure spending on AI and what's turned into an AI race? I think those are two of many critical data points that we'll be paying attention to, on top of what we talked about, tariffs. What do you think, Justin? What's the rest of the year look like?
I think you nailed your response. I would just first say that, what's the old adage? To get the right answer, you have to first ask the right question. And to ask us if our predictions to start the year played out is not, necessarily the right question, because to Ryan's point, we're not making predictions and then investing and just hoping that those predictions come true. Ultimately, what we're doing, depending on the strategy, is we're looking at a series of very predefined inputs, one of which is volatility of the market as it moves up or down, et cetera, and then we're adjusting based on the information as we get it. So with that, we're very pleased that our active strategies were much more defensive when things got very dicey earlier in the year, and have since been able to participate and be in a solid position to attack the rest of the year. And then to Ryan's point, our less active strategies, we've had a good allocation that we've ridden through the volatility, and those have also had a nice year. And it's not about predictions, I guess I would say. But if we are forced to make a prediction,
but let me predict.
But yeah, we can always predict, but I can assure you none of our strategies are going to be determined by our predictions coming true or not. But I think if we were to predict, the AI capex boom is the big driver of the U.S. economy. And as long as the labor market is strong, money will keep going into stocks. And, we're going to participate in that across our strategies, as well as what we think will be more idiosyncratic opportunities across a range of global markets. Just to round that off, though, I would conclude by saying that emotion of being afraid when the market goes down, and or emotion of being afraid of missing upside when the market goes up, that's never going to come into our analysis, and it's certainly never going to come into what makes us buy or sell securities. And over any period of time, any outperformance or underperformance versus any particular benchmark, that in and of itself will never be how we gauge what happened. We'll gauge what happened by, did we do what was right based on to Ryan's point, the mandates of a specific strategy.
Yeah, and that the clients are, working with their advisors to move into. But that'll wrap it up. We really grateful for the opportunity to do this. We don't take it lightly what we get to do every day, helping our clients and our advisors get down their financial journey of life. We'll be back with a chart overload in a couple of weeks, and we'll have one of these path forward webinars the end of next quarter. If you want to dig deeper, if you have any additional questions, reach out to your advisor or to us directly, info@sollinda.com, and we're happy to hop on a call or a Zoom. And one thing we never dodge talking about is the capital markets and where things are and where they could go. But anyway, hope everyone has a great rest of the week, and we'll see you next time.